The World Economic Forum recently released a report which can only be described as its magnum opus on digital currencies. Clocking in at over 200 pages, the report aims to inform governments, mega corporations, and other stakeholders about cryptocurrencies and central bank digital currencies. Today, I'm going to quickly explain what the World Economic Forum is, tell you everything its massive digital currency report says, and what it could mean for cryptocurrency. Before we explore the next chapter of the Great Reset, there's some important information that needs to be said. Nothing in this video is financial advice, so don't go placing any bets. Contact a financial advisor before investing to make sure you don't get wrecked. If this is the first time you see me on set, my name is Guy and I am a crypto cadet. My mission is to bring you the highest quality crypto content on the internet. Coins, tokens, news, reviews, and other topics I haven't thought of yet. If this is exactly what you're here for, subscribe to the channel and ping that notification bell to join the crypto call. If you don't have the time to watch the entire video in one sitting, you can use the timestamps below or skip ahead to find where you left off when you have time that needs killing. That's all you need to know about the Coin Bureau. Let's see what the World Economic Forum is saying about crypto. If you've never heard of the World Economic Forum before, here's what you need to know. The World Economic Forum is a non-governmental organization based in Geneva, Switzerland. It was founded in 1971 by Klaus Schwab, who has served as its executive chairman since that time. The World Economic Forum consists of over 4,000 of the world's most powerful people, including politicians, heads of NGOs, corporate CEOs, and other people you'll never see on the front page of any newspapers. These powerful people gather every year in Davos, Switzerland, to discuss the future of humanity without any tiresome input from the average person. These talks typically center around ideas and principles put forth by Klaus Schwab himself, such as the Fourth Industrial Revolution, the Great Reset, and stakeholder capitalism. As you can imagine, the World Economic Forum has a lot of influence, and the various reports its constituents have put together over the years often end up being the playbooks for governments and corporations around the world. The World Economic Forum's recent report on digital currencies is no exception. It's titled, quote, Digital Currency Governance Consortium White Paper Series. It was published on November the 19th, and it consists of 8 white papers about cryptocurrencies and central bank digital currencies. The Digital Currency Governance Consortium itself consists of around 20 people, including the CEOs of corporations such as Visa, MasterCard, Ant Group, and Fidelity, and high-ranking members from organizations such as the European Union, Financial Action Task Force, Bank for International Settlements, and the United Nations. The report itself was written by over 100 people from these corporations and organizations, as well as over a dozen cryptocurrency companies and projects, including Consensus, Ripple, the Stellar Development Foundation, Circle, and Elliptic. Now, I'll give you my thoughts as we go along, and if you want to learn more about the World Economic Forum and how influential it is, you can check out my video about its last cryptocurrency report and my video about ESG. Both will be in the description. Now, sit back, relax, grab a drink, and grab a snack, because there is a lot to unpack. The World Economic Forum's Digital Currency Report begins with a short preface which specifies that, quote, central bank digital currencies and stablecoins are the focus of this series of white papers. This is interesting but not surprising, because it's clear that governments around the world see stablecoins as a threat to the rollout of their central bank digital currencies, or CBDCs. CBDC development is being coordinated by the Bank for International Settlements, or BIS, which is again one of the members of the Digital Currency Governance Consortium that's behind this report. As I mentioned in my video about the BIS's CBDC report, it sounds like CBDCs are going to have some very dystopian properties, such as centrally imposed limits on holdings, spending, and borrowing for certain institutions and individuals. The next page provides a bit of background about the report, specifically that, quote, this series of 8 white papers delivers on the scope of work outlined in the forum's January 2021 publication, which was basically a sort of proposal for the current report. The authors again reiterate that this report only concerns stablecoins, but it notes that the Digital Currency Governance Consortium will be releasing another report about regular cryptocurrencies in January next year. You can bet I'll be covering that when it comes out. The authors also make the distinction between so-called retail CBDCs, which will be used by regular folks like you and me, and so-called wholesale CBDCs, which will be used by institutions and individuals with special privileges. Now, this is, of course, a very important distinction, which is seldom made in CBDC discussions. The introduction finishes off by acknowledging that some parts of this report were guided by discussions and presentations which took place at the World Economic Forum's Davos meeting, underscoring the importance of this event in shaping papers that tend to become public and corporate policy. The report then gives a breakdown of the 3 categories the 8 white papers fall into. These are regulatory choices, 3 white papers, value proposition for the so-called underserved, 2 white papers, and technology choices, 3 white papers. To keep things simple, I'll just tackle each white paper one by one. I'll just quickly point out that the World Economic Forum's definition of the term privacy in the glossary seems to include sharing information with the government. Keep this context in mind going forward. The first white paper in the report is titled, quote, The Role of the Public Sector and Public-Private Cooperation in the Era of Digital Currency Growth. This reminds me of that aforementioned CBDC report by the Bank for International Settlements, which laments the fact that it can't completely cut out retail banks and payment processors as part of its CBDC rollout. As it so happens, the preface notes that, quote, this paper explores potential roles that central banks and public institutions could take with respect to stablecoins and CBDCs. The first section of the first white paper concerns the mandates that the public sector, aka the government and central bank, should follow when it comes to stablecoins and CBDCs. The authors confirm that the focus around stablecoins comes from the announcement of Facebook's Libra stablecoin in 2019, and that CBDCs are seen as a tool by central banks to combat stablecoins as well as regular cryptocurrencies. The authors then provide a breakdown of the different mandates public institutions should focus on when it comes to stablecoins and CBDCs. These are consumer protection, financial stability, monetary stability, competitive markets, market integrity, and the prevention of illicit activity. Now, funnily enough, the paragraph next to the final mandate admits that, quote, countries regulate their financial and professional sectors for anti-money laundering and combating the financing of terrorism based on the Financial Action Task Force, or FATF, recommendations. Now, I say funny because the FATF has no regulatory authority on paper, but its recommendations eventually become regulations in practice. The authors note that the FATF recently released its finalized recommendations for cryptocurrency, and I happen to have a video about them which you can find in the top right. Part 2 of the first white paper concerns the role of the public sector in CBDCs and stablecoins. A little infographic provided on this page basically sums it up. For stablecoins, governments and central banks should provide monitoring and regulation, especially when it comes to reserves, engage in actions that support innovation by providing a sort of safe space for stablecoin issuers to test new technologies, and grant stablecoin issuers access to central bank reserves. This third prerogative stems from the concerns about the assets that back stablecoin tokens. If everyone came to cash out their USDT from Tether at the same time, they may not be able to liquidate their collateral in time or at the same price to provide these dollars to stablecoin holders. The authors note that a simple solution to this problem would be to create a so-called synthetic CBDC, which is where a private stablecoin issuer, such as Circle, keeps all its reserves with the central bank, which is pretty crazy if you ask me. The authors spend quite a bit of time talking about a synthetic CBD setup and even provide a list of considerations for any countries which are considering issuing a synthetic CBDC. The United States seems to be close to doing this with Circle and USDC, if you ask me, but that's a topic for another time. For CBDCs, governments and central banks should be in charge of the creation of CBDCs, the monitoring, research and experimentation of CBDC technology, and the examination of alternatives to CBDC issuance. When it comes to the creation of CBDCs, the authors note that, quote, if two of the benefits from the envisaged CBDC do not outweigh the risks and downsides, then the CBDC should not be created. This again reminds me of the aforementioned CBDC report by the BIS, because in it, the BIS admitted that the risks of CBDCs seem to outweigh the benefits, hence why most individuals and institutions would never voluntarily accept a CBDC. The authors in the World Economic Forum report then repeat what the BIS said in its report, and that's that central banks should consider imposing different conditions on different individuals and institutions when it comes to CBDCs, which is not concerning in the slightest. The third section of the first white paper concerns the cooperation between the public and private sector when it comes to CBDCs. A table on this page conveniently lays out the different dimensions of this cooperation. For stablecoins, the public and private sector should cooperate on regulation, innovation, synthetic CBDC development, and the prevention of illicit activity. Pretty straightforward. For CBDCs, the public and private sector cooperation looks like a more one-sided deal, with the private sector helping public sector participants develop their CBDC, provide any knowledge they have about digital payments, help them test their CBDC, provide the payment rails for their CBDC, and ensure their CBDC is interoperable with all existing payment systems. I suppose the private sector will get lots of filthy fiat in return, but at this point I think they prefer to get some cold hard BTC. The final paragraph in the third section of the first white paper caught my eye, and that's that, quote, existing private sector blockchain-based digital assets could potentially assist in the facilitation of cross-border wholesale interbank CBDC payments and transactions. Examples include the utility settlement coin, USC, and XRP digital assets. Now, did I mention that someone at Ripple was a contributor to this report? Anyways, the fourth section of the first white paper concerns intergovernmental collaboration on stablecoins and CBDCs. It highlights 4 areas: the prevention of illicit activity, consumer protection and privacy, recall the questionable privacy definition I mentioned earlier, CBDC interoperability, and CBDC risk management. The authors admit that the prevention of illicit activity necessarily entails infringing on the privacy of stablecoin and CBDC users. The authors also imply that this information will be shared with foreign governments when transferring stablecoins or CBDCs overseas when all is said and done. As far as CBDC interoperability goes, the authors applaud the idea of an integration of multiple CBDCs into a single CBDC system called mCBDC, which is currently being tested by the central banks of Hong Kong, Thailand, the United Arab Emirates, and China. When it comes to potential CBDC risks, the authors outline a series of scenarios such as exchange rate volatility, illicit activity, operational costs, tax avoidance, and, the greatest sin of all, quote, potentially heightened data privacy. The first white paper concludes by calling for, quote, global coordination, including with the private sector, which seems to be the catch-all solution to every perceived problem these days. The authors also note that, quote, stablecoins present more immediate risks as their issuance grows rapidly while regulatory coverage is currently limited. On that note, if you happen to be curious about who has been buying all that USDT that keeps being printed by Tether, I have a video about that which you can find in the top right. The second white paper in the report is titled, quote, Regulatory and Policy Gaps and Inconsistencies of Digital Currencies. If the title wasn't self-explanatory enough, the preface notes that, quote, this white paper explores potential regulatory and policy gaps and inconsistencies that stem from existing approaches towards retail CBDCs and stablecoins. Note that wholesale CBDCs are not part of this equation. The first section of the second white paper concerns just that, the regulatory and policy gaps and inconsistencies and these fall into 4 categories. Gaps and inconsistencies caused by the rapid evolution of digital currency technologies and the reactionary nature of laws and regulations, think the Howey test for securities. Gaps and inconsistencies caused by the overlapping jurisdictions of regulators, think the different securities designations of XRP by different regulatory bodies in the United States. Gaps and inconsistencies caused by a lack of global coordination, because God forbid there's a free country somewhere. And gaps and inconsistencies caused by the similarities between stablecoins and CBDCs, which is the pinnacle of hypocrisy. Now, what concerns me here is the attitude of the authors towards self-hosted cryptocurrency wallets, which they seem to see as a threat which needs to be addressed. As I mentioned in my video about the worst case for cryptocurrency, the ability to hold your own coins and tokens is one of the prerequisites for financial freedom, because when your assets are held with a third party, they technically own that asset and can block transactions or worse. Organizations such as the FATF are not fans of cryptocurrency's self-custodial features on the grounds that they facilitate money laundering. Now, luckily, the FATF is not currently concerned with self-custody, and it doesn't matter anyways because studies suggest that the FATF's recommendations don't work in combating money laundering. I digress. When it comes to the similarities between stablecoins and CBDCs, the authors suggest that the same regulations be applied to CBDCs and stablecoins, especially if they end up coexisting. This could be a very good thing or a very bad thing, depending on how these regulations are written. Part 2 of the second white paper concerns the guiding principles for stablecoin and CBDC regulations. The authors call for international cooperation and essentially instruct public and private institutions to engage with unelected entities such as the Bank for International Settlements and the Financial Action Task Force, as if they didn't have enough power and influence already. The authors also call for a, quote, risk-based approach to regulating digital currencies, which is code for allowing technological innovation, but only behind closed doors and under the watchful gaze of the government. Now, I couldn't help but notice the following sentence, quote, "It's important to offer the same opportunities to both startups and existing players when it comes to innovation. Because obviously the worst thing in the world would be for some small up-and-coming companies to kill the status quo. Heaven forbid." Part 3 of the second white paper concerns the creation of a framework to address the aforementioned gaps and inconsistencies in laws and regulations around stablecoins and CBDCs. The authors were kind enough to create a simple flowchart for creating such a framework. The authors then break down each step in detail with a series of, quote, exercises. They even provide a worksheet that can be printed out and filled in by hand. This makes me wonder how many other forms the World Economic Forum is providing to regulators around the world. Anyways, the second white paper concludes by saying that countries need to be careful about over-regulating digital currency technologies, as it could put them at a huge disadvantage. Finally, something we can agree on. The third white paper in the report is titled, quote, Digital Currency Consumer Protection Risk Mapping, which is a nice little word salad, isn't it? According to the preface, quote, this white paper maps the risks of using various forms of digital currency compared with existing forms of payment and currency. The first part of the third white paper concerns the landscape of the current risks associated with stablecoins and CBDCs, a bird's eye view, if you will. After presenting a few flowcharts of their own, the authors note that, quote, this white paper focuses primarily on stablecoin consumer protection issues, while also mentioning where these may be relevant to CBDCs. Apparently, the only consumer-related risk associated with CBDCs is a loss of privacy, but there are, of course, other risks related to the intense centralization of financial power and how it can be used to censor some individuals and institutions while bolstering others. Speaking of which, the next subheading notes that, quote, risks may vary according to different types of users, suggesting that there will be different rules and regulations for different users according to the category they fall into. Although the authors define a few potential user categories in an image, they do not specify which user categories are high risk or low risk. Interestingly, the authors place the risks associated with stablecoin use into 3 buckets: investor, retail buyer or seller, and participant in protocol governance. This third risk is strange for 2 reasons. First, it's about the accountability within stablecoin ecosystems, which clearly falls on the issuer, assuming it's a peg or redemption issue. And second, holding a stablecoin like USDC doesn't give you governance over Circle's stablecoin protocol. What's even stranger is this image provided by the authors, which shows stablecoin holders having governance rights. I suppose this governance setup applies to privately issued stablecoins, such as JP Morgan's JPM. Ugh. Now, in any case, the main concern of the authors when it comes to consumer protection is the assets backing the stablecoin tokens in circulation. They identified Tether as the stablecoin issuer of concern due to the quality and lack of transparency about the assets backing USDT. As I mentioned earlier, low-quality collateral could lead to redemption issues if everyone decided to convert their USDT to dollars at the same time. The thing is that most cryptocurrency investors are aware of these risks, which is why they've been migrating to more regulated stablecoins like USDC and decentralized stablecoins like Terra's UST. As the authors rightly point out, however, the average person has no idea that there's a big difference between different types of dollars, be they physical dollars, digital dollars, or stablecoins. This presents yet another risk to consumers. Part 2 of the third white paper concerns the top-line consumer risks with stablecoins and CBDCs. This section begins with a very comprehensive image about the risks associated with the different kinds of currencies I just mentioned. Notice how there are plenty of risks associated with CBDCs too, and I would argue they're much worse than the risks associated with stablecoins. To my mind, the only real risks associated with stablecoins is the centralization of their off-chain operations, and of course, the quality of the assets backing stablecoin tokens in circulation, which the authors address again in this somewhat unfair image. The authors then dig into other risks, such as depositor protection, payment risks, privacy risks, security and technology risks, and accountability risks. In terms of privacy risks, the authors single out blockchain analysis companies as being problematic. Quote, "These are organizations that analyze on-chain transactions and can match such data with other publicly available data." The fact that the authors raise blockchain analysis companies as a concern is quite ironic, because being able to track everything in such a manner seems to be the dream of many regulators around the world, and likely more than a few members of the World Economic Forum. Another point that stuck out to me was in the accountability section, and that's that, quote, "Consumers may play a more active role in the process of creating and maintaining some stablecoins, in that they can propose and approve new governance rules. In this capacity, consumers act in a similar manner to shareholders of a company." The authors then explain that this could justify the application of securities laws to some stablecoins, something which SEC Chairman Gary Gensler has said on many occasions. Part 3 of the third white paper concerns recommendations around how to handle the risks associated with stablecoins and CBDCs, and the authors outline 4 sets of recommendations. The first is, quote, "Same activity, same risk, same regulation," which sounds good to me. The second is consumer education, which is what I do every day. The third is new regulations and audits, which includes, quote, "setting limits to the sizes of transactions and wallet balances to limit the risk exposure of consumer, specifically for the so-called underserved." In a paragraph in this section, the authors basically say that underserved is anyone who is not a, quote, "high asset or high income constituent or institution," meaning that regular folks like you and me will likely see limits placed on our CBDC and stablecoin holdings in the future. Can't wait. Anyways, the fourth set of recommendations relate to authorization and supervision, specifically regarding the issuance and redemption of stablecoins or CBDCs. Here, the authors underscore the importance of developing comprehensive regulations around the custody of digital assets. Now, I happen to have a video about the importance of cryptocurrency custody, and you can find it up there in the top right. The third white paper concludes with a short summary of everything I just said, and once again stresses the importance of educating people about these kinds of technologies. The fourth white paper in the report is titled, quote, "What is the value proposition of stablecoins for financial inclusion?" The preface clarifies that, quote, "This white paper investigates the benefits and limitations of stablecoins for supporting financial inclusion in historically excluded or underserved populations." While the authors note that 1.7 billion people are currently unbanked, they do not say how large the underserved population is, probably because it excludes just about everyone except the members of the World Economic Forum. Now, jokes aside, this fourth white paper takes a more research-based approach compared with the first three white papers, and its first section concerns the context and approach the authors took in assessing the effects stablecoins have on financial inclusion. The authors begin by identifying the existing barriers to financial inclusion and notes distrust in financial service providers and the government as the first one, which is quite ironic given the context of this entire report by the World Economic Forum. As with many academic studies these days, the authors took a qualitative rather than quantitative approach to analysing the risks and benefits of stablecoins using only 3 case studies. The first case study concerns a, quote, "undocumented individual in an urban area of the United States, US, sending remittances home to Honduras." The second case study concerns a, quote, "small business in India making domestic payments." And the third case study concerns, quote, "a digitally savvy gig economy individual in urban Cameroon receiving wages from the US." Naturally, the authors use the, quote, "groundbreaking financial needs framework developed by the Bill and Melinda Gates Foundation and the MasterCard Foundation as their measurement tool." Part 2 of the fourth white paper concerns the key findings, and the conclusion can be clearly seen below the title. Quote, "Stablecoins currently offer limited benefits." This is basically because stablecoins lack the adoption required to work without interacting with the existing financial system. Put differently, there aren't many places you can actually spend stablecoins, especially in developing countries. This means the only option is to cash out, and often that can't be done either. Even so, the authors follow up by saying that stablecoins can increase financial inclusion and even explain how they can be used to overcome a few of the barriers to financial inclusion they mentioned earlier. The authors then detail the benefits of the blockchains that stablecoins live on, noting that they can provide various benefits such as increasing access to credit. This is because the public transaction history of stablecoins would make it easy for financial institutions to assess a person's creditworthiness. Now, as awesome as this is, it's also concerning, since transaction history could be used by financial institutions to enforce policies unrelated to finance, such as those found under the ESG umbrella. The authors also describe the potential to create decentralized digital identities, wherein each person is completely in control of their own data rather than having it stored and validated by a centralized authority. This talking point conflicts with the limitations stablecoins apparently present for financial inclusion, which are detailed on the next page. Besides the lack of identity documentation, the authors note a lack of infrastructure, financial literacy, and internet access as being other limiting factors associated with stablecoins. The authors also go over the risks discussed in previous white papers, along with more straightforward risks like accidentally sending stablecoins to the wrong wallet address. As I hope you all know, all cryptocurrency transactions are final, and that's a lesson I'm sure many of us have learned the hard way. The next subsection caught me off guard because it discusses non-financial and non-technical risks to financial inclusion, and the first one is the possibility of widening the gender gap in financial access because men are more interested in financial technologies than women on average. Quote, "Unless the ecosystem focuses deliberately on building inclusive models at scale, this trend may continue and stablecoins may risk increasing inequality in financial services and technology access." This is definitely a problem that needs to be addressed, but I can't help but think that a centralized solution to this problem will probably be even more problematic. Good thing there are already decentralized initiatives happening in this area. Part 3 of the fourth white paper concerns the, quote, requirements for stablecoins to improve financial inclusion. In addition to the basics like high speeds and low transaction fees on the underlying blockchain, the authors note, quote, minimum privacy as one of the prerequisites, on the grounds that this will minimize user error when sending funds. Always in the name of safety and consumer protection, eh? Anyways, parts 4, 5, and 6 of the fourth white paper are detailed breakdowns of the 3 case studies the authors used as part of their research, and nothing there really caught my eye. This brings us to the conclusion of the fourth white paper, which contains a counterintuitive statement. Quote, competition in remittance providers, remittance volumes, and accommodating KYC and other regulations are among the leading factors that correspond with lower remittance prices. Well, I reckon Salvadoran citizens would strongly disagree on that one, and you can learn more about how El Salvador made Bitcoin its national currency by clicking the link up there in the top right. The fifth white paper in the report is titled, quote, blockchain-based digital currency and tools for cross-border aid disbursement. The preface reiterates that, quote, this paper explores the applications of digital currencies and blockchain-based tools for cross-border development and humanitarian aid delivery and disbursement. Before you ask, yes, I searched the document for Shiba Inu and SHIB, but nothing came up. A bummer considering Vitalik Buterin donated $1 billion of the meme coin to India's pandemic relief fund, which certainly deserves some recognition. Part 1 of the fifth white paper concerns the, quote, priorities for blockchain-based digital currencies in humanitarian aid, and much of what's said overlaps with the content of the previous white paper. Among the differences is a greater focus on digital ID, and the authors say that requiring digital identity to receive foreign aid would incentivize unbanked people to join the financial system. Now, this sounds eerily similar to a cryptocurrency project called WorldCoin, which I covered in another video. It basically promises to give mostly poor people cryptocurrency if they scan their eye using a digital orb which harvests their biometric data. Sounds like the World Economic Forum is taking notes. Now, ironically, the authors discuss the ethics of cryptocurrency use in humanitarian aid shortly afterwards, and admit there are multiple trade-offs involved in case that wasn't clear enough already. The authors also talk about programmable aid, wherein, quote, blockchain-based digital aid could be programmed to be spent at certain qualified vendors or within certain geographic areas, which echoes the kind of centralized control you find with central bank digital currencies. The only thing more terrifying is a global digital currency, which the authors happen to discuss in the next subsection. Quote, our interview respondents raised the potential value that lies in a consortium of aid organizations creating a global stablecoin for aid disbursement. What could possibly go wrong? Part 2 of the fifth white paper concerns, quote, pilot projects for blockchain-based digital humanitarian aid. This section lists about a dozen such pilots, which include USDC issuer Circle, cryptocurrency company Consensus, and cryptocurrency project Celo. It also includes some more concerning pilots, such as rapid KYC, unnecessarily detailed tracking of foreign aid payments, and last but not least, Facebook's aka Meta's Libra aka DM stablecoin. Now, you can learn more about Facebook's, Meta's, failed stablecoin using the link in the description. The fifth white paper concludes by saying there are some serious ethical considerations involved in using cryptocurrency for humanitarian aid, and any companies engaging in it should consider speaking to the people they're coercing, helping. The sixth white paper in the report is titled, quote, Privacy and Confidentiality Options for Central Bank Digital Currency. And I think that last word should be pluralized unless they're talking about a global central bank digital currency. Wouldn't that be crazy? The preface again notes that, quote, this paper explores the spectrum of technology-based privacy and confidentiality options for designing central bank digital currency, CBDC, with a focus on cryptographic techniques. Emphasis on the word spectrum. Part 1 of the sixth white paper concerns the different choices for privacy technology. It starts off by giving 2 examples of privacy in government-issued digital currencies. The first is the Swedish e-krona, which provides privacy and confidentiality, and the authors actually direct the reader to the glossary after mentioning both of those terms, which adds credence to the notion that privacy means you plus the central bank and the government. The second example of privacy the authors give is China's digital yuan, and no, I'm not joking. At least the authors admit that the People's Bank of China can see everything. The authors then get into what they call, quote, the frontier of privacy-enhancing techniques for financial systems, and judging by the titles of the publications they cite here, these also consist of privacy techniques where transactions are private, except to the central bank and government. Regarding the requirements for a privacy-preserving financial system, governments and central banks should do their best to ensure that their CBDCs offer ample functionality, provide privacy guarantees, and come with lots of security features. The next subsection breaks down the specific cryptographic technologies that governments could use in their CBDCs, including zero-knowledge proofs, symmetric key cryptography, hash functions, public key cryptography, multi-party computation, differential privacy, and homomorphic encryption. I hope you'll forgive me for not explaining all of those in detail here. In terms of advanced features, the authors note that CBDCs could come with built-in auditing features, which will ensure that, quote, visibility on transactions of specific types, as well as on specific tagged people and on transactions between specific individuals, are tracked and traced. They also note that CBDCs could be programmed to automatically flag suspicious transactions and even prevent transactions above a certain amount from going through at all. Truly amazing tech. Best of all, the authors admit there's likely to be some data leakage involved with CBDCs, which could cause serious issues down the line. Part 2 of the 6th white paper concerns the policy and regulation around privacy technologies for CBDCs. The authors start off by basically saying that the degree to which central banks and governments can get away with violating privacy with a CBDC depends on how much their respective citizens trust these institutions. Not surprisingly, most people don't trust their government or their central bank, but the authors note that people do trust some corporations, implying that they could be the Trojan horse for the deployment of a privacy-violating CBDC. Come to think of it, I do trust Circle more than I trust the Federal Reserve. On that note, in the next subsection about privacy principles and data subject rights, the authors note that, quote, people should be able to use a US CBDC without making themselves subject to undue corporate tracking or government surveillance, which is very interesting to say the least. The authors then provide a nifty table, which is aptly titled The Spectrum of Privacy, which cautions that too much surveillance will hinder the adoption of a CBDC, though there are, of course, many other factors that I've already discussed that provide more than enough deterrence on their own. The last subsection is my personal favourite, and it's titled, quote, The Role of Digital Identity in Privacy for CBDC. I reckon the only thing that people would resist more than a CBDC is a centrally controlled digital identity which can be used to restrict your movement. Good thing digital IDs are a long way away. The 6th white paper concludes with, quote, privacy in CBDC will require a dynamic and nuanced approach to technical design and choices. Nice choice of words. The authors call for, quote, governments and other stakeholders, aka corporations, to sit down and discuss how digital identity solutions can be used in conjunction with CBDCs, among other things. The 7th white paper in the report is titled, quote, Defining Interoperability, and apparently the definition of interoperability is 12 pages long. In any case, the preface repeats that, quote, this paper explores various forms of digital currency interoperability and considers a definition for what the term should mean. The authors then explain that interoperability has a different definition depending on the context, and they define 4. Business interoperability, technical interoperability, regulatory interoperability, and legacy interoperability, i.e. interoperability with the existing financial infrastructure. Part 1 of the 7th white paper concerns the design principles of interoperability. These are universality, privacy, resilience, security, friendly competition, vendor neutrality, availability, standards compliance, durability/finality, atomicity, predictability, local efficiency, international efficiency, low cost, user trust and adoption, and risk reduction. Big brains behind these words, I tell you. Part 2 of the 7th White Paper concerns interoperability between CBDCs. After touching on the importance of interoperability between retail and wholesale CBDCs, the authors discuss the benefits of having a single global CBDC system, because that's obviously the best option here. Part 3 of the 7th White Paper concerns interoperability between stablecoins, which already exists, by the way. This is probably why the authors focus on emphasizing the interoperability challenges for stablecoins. Can't have those CBDCs looking bad, can we? What's cool is that the authors outline a few interoperability solutions for stablecoins and include crypto projects such as Cosmos and Polkadot on their list. Part 4 of the 7th White Paper concerns the technical standards for CBDCs and stablecoin interoperability. The authors identify 7 standards here: messaging, privacy, anti-money laundering, identity and authentication, distributed ledger protocols, certification, and intercurrency exchange rates. Now, the 3 that stuck out to me the most were obviously privacy, anti-money laundering, and identity and authentication, which go hand in hand. On the privacy side, the authors note that, quote, when interoperating, the level of privacy would default to the lowest common level of privacy used for both stablecoins and CBDCs. As for AML and identity, the authors also discuss digital identities connected to every stablecoin and CBDC transaction, though they do note that this digital identity could be done in a decentralized manner. The 5th section of the 7th White Paper concerns a few additional considerations for interoperability. This includes things like the integration of CBDCs and stablecoins into the existing payment system, vendor neutrality, the resiliency of interoperable digital currency networks, and even open sourcing interoperability technology. The 7th White Paper concludes by calling on central banks to work with corporations on interoperability solutions. I think I'll just stick to using Cosmos, and you can learn more about Cosmos using the link in the top right. The 8th and final white paper, thank the Lord, in this report is titled, quote, CBDC Technology Considerations. The preface begins with, quote, this white paper presents information for policymakers to help inform their choices around the technical design requirements and security features for an effective central bank digital currency. Part 1 of the 8th white paper concerns CBDC policy goals and technical design considerations, and I already don't like where this is going. The authors identify 8 policy goals for CBDCs. These are continued access to central bank money, financial inclusion, payment system efficiency, payment system safety and resilience, mitigation of currency substitution risk, improving payments and banking competitiveness, monetary policy implementation, and household fiscal transfers. Now, I know these policy goals sound warm and fuzzy, but remember that central bank money is the root of all evil. Financial inclusion means digital ID, payment system efficiency means extreme centralization, and payment system safety means no privacy. The use of CBDCs to mitigate currency substitution is something we're seeing in many small countries right now, and though I'm not a fan of fiat in any iteration, I honestly love seeing small countries protect themselves against dollarization. It's too bad that global regulators don't seem to share the same sentiment and frequently warn of the risks associated with rolling out CBDCs whenever they're issued by the central bank of a smaller country. As for using CBDCs as a means of improving payments and banking competitiveness, the Bank for International Settlements admitted that CBDCs will have the opposite effect because everyone will just park their money at the central bank. Most retail banks would go bust, and the few that survive would charge insane interest rates on loans to stay profitable, meaning the average person wouldn't be able to borrow the money they need to buy a car or a home. This, coincidentally, ties into one of the tenets of the Great Reset, which is that you'll own nothing and be happy. Meanwhile, the stakeholders at the World Economic Forum will own everything and be even happier. It's a brave new world, folks. Now, when it comes to monetary policy and CBDCs, the authors note that, quote, most economists have not expressed much conviction in this opportunity. The opportunity being the ability for the central bank to expand and contract the money supply at will and even impose negative interest rates. The authors seem to be saddened by the fact that negative interest rates aren't currently possible due to cash, but they would be if, quote, physical cash is abolished or generally unavailable. Now, obviously, people aren't just going to give up their cash, at least not unless its value is completely inflated away by endless stimulus at the hands of central banks in response to a global crisis. Wait a second. Nah, it's probably nothing. Speaking of stimmies, helicopter money is what the authors mean by household fiscal transfers, and they actually call it helicopter money in the subsection too. Quote, the transfer payments could also be programmable, with conditions such as expiration upon a certain date or a requirement to spend the funds at certain vendors. Sounds more like ball and chain money, if you ask me. Part 2 of the 8th white paper concerns the trade-offs for a blockchain-based CBDC versus a CBDC existing on a handful of servers of a central bank, for example. The trade-offs here are really quite nuanced, and a lot of them depend on whether a CBDC blockchain will be public and permissionless or private and permissioned. Most of the downsides have to do with the increased responsibility and maintenance costs by the central bank, a hot potato that I'm sure they'd rather toss to a private entity which can be easily blamed and sued if anything goes horribly wrong. That said, the authors note that, quote, central banks are extremely likely to limit participation by private firms, restricting access to the CBDC network to those who are licensed, regulated, and have a track record of stability, rather than fully allowing public access. Privacy for me, not for thee. Part 3 of the 8th white paper concerns the cybersecurity considerations for CBD systems, and this is where things get very interesting. For starters, it would probably be the end of the world for whichever poor soul had their credentials stolen, especially if CBDCs become linked to digital IDs. The authors seem to imply that this credential theft would come from the handful of lucky users with privileged roles, which include the government and law enforcement agencies, which will have the power to freeze and withdraw funds from CBDC accounts. This is fine as far as the authors are concerned because, quote, these capabilities are in line with today's compliance procedures in regulated payment systems. Well, I guess that's completely fine then. The authors also cover the possibility of denial of service attacks, aka spamming the CBDC network, double spending by malicious nodes on the network, and the greatest existential threat to financial technologies, quantum computers. What's scary is that the authors say, quote, quantum computers developed in the future may be able to break current cryptography without detection. Quantum computing will ultimately impact all financial services as it compromises major data encryption methodologies used today. The 8th white paper concludes with a few short paragraphs about how the authors hope governments and central banks will consider all the dystopian stuff when they get around to making their CBDCs. Oh, and if you're curious about how much of a threat quantum computers are to cryptocurrency, you can check out my video about that using the link in the description. Well, that's it for my summary of the World Economic Forum's report on digital currencies. Now, this is the longest video I've made so far, and I'd love to get your feedback in the comments section. Did it work for you? Was it better than binge-watching all 3 series of Succession, or did you lose the will to live around the halfway mark? Do let me know. Now, if comments aren't your thing, you can let me know if you enjoyed the video by smashing the like button. If you plan on coming around again, make sure you've subscribed to the channel and ping that notification bell. If this insanely long video somehow didn't scratch your itch for crypto content, you can check out my second channel called Coin Bureau Clips. If you want to get my thoughts in real time and see what I get up to behind the scenes, follow me on Twitter, Instagram, and TikTok. If you're having a hard time keeping up with the crypto market, join my Telegram channel to get concise daily crypto updates. I've even got a weekly newsletter where I talk about what's been going on in the crypto market, tell you about the videos I'll be covering next week, and even reveal my personal cryptocurrency portfolio. Christmas is coming soon too, and if you're looking for a crypto gift for your friends, family, or you, heading over to the Coin Bureau merch store is what you should do. You can find your way to all these resources using the links down below. Thank you so much for watching until the end, my friends. It won't be long until I see you all again. Hodl until the end. Ta-ta.